Stephen, a pleasure to have you on the show. Quite timely, of course, given that we are coming off quite a surprise out of the Fed. Do I want to be near anywhere the Treasury market right now?
I think you do, as a matter of fact, because the expectations that Powell has laid out significantly increases the probability of a recession in the next 12 months. And the implication of that is that treasuries are approaching their peak levels, although the Fed is certainly far from done right now. And you're seeing that reflected in part by the increased inversion of the yield curve as well.
So what do you see the most opportunities? Do you look more towards the short end, where yields have picked up substantially higher, or do you look at more the longer end now?
I think the opportunity set is really more on a barbell approach basis. First, at the short end, you're getting pretty sufficient yields with a roll down effect if you're targeting Treasury sort of in the 6 months to even up to a 2-year time horizon. And I believe that there is an element of risk that despite their guidance about where they expect to head with policy rates next year, that they will pull back potentially more so than they will be more aggressive relative to their forecast at this point in time. Conversely, I think if you look further out on the yield curve right now, particularly with respect to the kink into 20-year part of the curve, that presents an opportunity as well. And if the Fed does raise rates to their targeted levels, one of the challenges that they face is that rather than tightening conditions at the back end of the curve by simultaneously increasing it, I think they create conditions where the back end of the curve rallies further.
Stephen, so is 60-40 the strategy, with 60 being in the bond market?
Historically for the last several years, even though I represent fixed income, our mantra has been that there's substantial risk in fixed income, and investors should consider reducing their fixed income exposure. I think that equation is changing today. I think the historical notion of 60-40 is evolving, and it's no longer necessarily what both investors, pensions, and institutions are focused on going forward. But I think it makes sense now to start increasing your exposure within fixed income at these elevated levels. And in particular, we believe that we are at or near approaching the peak of this fixed income cycle with respect to where rates are going to be. Now, the challenge is going to be that despite the elevated yields and rates right now, that many would argue that you're still not getting sufficient returns to offset where inflation levels are today. But you have to look at the world in terms of the best relative value and what is sufficient as opposed to what is ideal in terms of your return outcomes. And fixed income levels are now reaching those sufficient levels.
Right. Okay. So let's dig deeper then into fixed income. Do I move up the credit curve? I mean, we've talked so much about treasuries. What about credit, IG, and high yield?
We have had an environment recently where, despite the elevated risk, ranging from the Fed to geopolitical risk, credit markets have been relatively benign in terms of its outlook for potential recessionary downside risks overall. We have been starting to see that shift in recent weeks, and credit spreads have widened fairly significantly. But in looking forward at where credit spreads are indicating relative to what the return potential is, return horizon and time horizons are very important. So I would characterize current spread levels in corporate credit, both at the investment grade level, but particularly within the high yield and leveraged finance component, as quite attractive on a longer term outlook basis of perhaps 18 to 24 months. But in the very short term, over the next 1 to 3 month time horizon, spreads are likely to get cheaper and wider relative to tighten. So again, we would not necessarily materially increase our credit exposure today, but we think that there's value currently.
So very quickly, how does the dollar play into your investment thesis?
Well, one of the other primary themes of this year and over the past 12 months has been the dollar strength, and you see that where DXY is. We do believe that the dollar strength will persist for the next 6 months. However, after the next 6 months, we will be reaching a peak, and then we will see a bit more of a normalization because by many fundamental measures, the dollar is overvalued and will continue to get overvalued. And so we see that tide turning. And so for us, what that means is to the extent that currency positions are being put on portfolios, we would maintain the overweight to the dollar exposure in the near term, but we would start to neutralize that overweight within the next 6 months with the view that we would underweight potentially the dollar there beyond.